across to another market guest this time. Again, you get to see them only at the sidelines of their conference. And Chirag Negandhi of Access Capital is now with us, joint MD and co-CEO, of course, at the company, is with us. So just before we start about the markets, what's happening, can you just tell us what has been the response to this virtual conference? Yesterday, we spoke to a few people down the conference. It's a two-part conference, which, of course, the bigger conferences currently that we are undergoing. What is the sort of response that you have got? Is the response much better than what you anticipated because people are attending this from their homes?
Thank you. To start with, you're right. This is a two-part conference. This is a series 2 of what we're calling our digital access. We have about 45 companies worth about $300 billion in market cap, about 350 fund reps, and about 1,300 meetings. Our previous one, which was towards the end of May or the early part of June, was 21 companies with about $250 billion in market cap with about 650 meetings. So in all, we've done about 2,000 meetings. Without doubt, the interest to understand where each company stands today. Our focus really has been on some of the large and mid caps, where the companies stand today and how they're looking at this environment and how their plans over the next 18 months is something that everyone wants to understand, and we're seeing the most phenomenal response that we've witnessed in a long, long time.
So, is the focus or the theme in and around how people will cope up from this lockdown and how they will restart and emerge as stronger? Is that the main thing that investors are looking for?
No, I think the focus really is to understand where each of the companies stands today. What they're doing, how much of a disruption has happened during COVID, and how they intend to come out of how they intend to deal with the COVID scenario to move are they looking at raising capital? Are they looking at acquisitions? How are they on their, where they are on the cash flow position for each of them? Whether demand is coming back for them. We have some companies that are, that have a greater exposure to the rural markets. They're seeing a much, their bounce back has been much sharper. And therefore, it's just a broad understanding. And people are also looking at this bottom up to try and get a sense of where, the ultimate demand will be and how the GDP will play out over time as well.
Right. What will be your sense of the recent recovery that one has seen in global markets? What is the sense that you get? Also, when we talk about your company, you all have been involved a lot in M&As, block deals, which have been happening in and around. What is your sense regarding the sort of block deals that you're seeing and the sort of response that, probably a Kotak, a Bharti, or some of these large, really quality names got?
What we're seeing is very clearly global liquidity that is pushing the markets up. And this is not only happening in India, it's also happening globally. You've seen about $5.3 trillion of printing that has come through from the G3. You're also seeing about 40,000 crores that have come into the Indian markets, both from the FIs and DIIs. The 8,100 odd crores of SIPs continue. During and post the SBI Cards IPO, we saw a great buildup in new demat accounts and retail accounts, and we're seeing that continue. So it's obvious that liquidity from all corners is actually flowing into the markets. And as that liquidity remains, without conviction in terms of where the economy and the GDP will grow, and therefore, there is the clarity that people do not yet know how the post-COVID scenario emerges. What is very clear is that the big will become bigger, and therefore the opportunity when some of these large companies are coming in raising capital for this money to actually absorb some of this and increase their stake there, because they will definitely be around and will only grow stronger in a post-COVID environment. And which explains the absolute demand for these blocks. The supply here is just bringing in the demand. So any large company, and that's what we're talking to all of our corporates as well, any large company looking to raise funds, either to kind of fund their next 6 to 9 months of their working capital and other growth needs, or looking opportunistically at acquisitions. This is the best time. There is a clear dislocation between the markets and the economy, and this is a great time and great opportunity to come and raise that capital to take advantage of that dislocation.
Right. Also just a word on, Q4 numbers or probably FY21 numbers. When you're engaging with your clients, especially FIIs, big DIIs or big long only funds, what sense you get? You think people have written off FY21 numbers? Maybe it's a 10 crore loss or a 50 crore loss, but the focus is on the core value of the business and the rebound that can happen in 22?
Oh, absolutely. I mean, FY21 for most is seen as a washout, and I don't think anyone's kidding themselves about that. What they're looking at is FY22 and how sharp can the bounce back be in FY22, and if you draw out scenarios of how things could come back, and most people here expect that there will be a second wave, and therefore the stop start of the economy is a high possibility, and therefore the focus on moving towards the large caps and the more liquid names. But yes, the general belief is, and the understanding is that FY22 will probably be back to FY20 levels for most companies, where the small and large caps where the small and mid caps will find it far more difficult if there is not a sustained economic recovery. Their earnings will be far more volatile, and therefore focus on the large liquid names, which could see FY22 being equal to or better than what FY20 numbers were.
Right. Also, let's talk about financials. When we talk about financials, the big ones, the small ones, everyone is looking to raise money. Do you think this year for financials, whether it's a large bank, small bank, mid-sized bank, all will need to raise money in the near term?
Well, look, like most participants in the market, including the corporates themselves, the banks themselves it's difficult for them to fathom at this point how big this issue could be. And therefore, you can't blame the financials for the need to create the war chest, that when they go into something where the economy actually starts playing out and they start seeing the level of bankruptcies that come in or bad book that builds up, they should have the capital to tide through that. So yes, I would expect that most financials would be ready and willing to raise capital at these times. I do believe that you will see a positive surprise in the financials in terms of the lower moratorium numbers, especially in the private banks, that will definitely come in. You can anecdotally checking with all of the corporates, we are seeing that the second moratorium, the banks have not been as willing to extend that to most corporates unless it's a COVID-related moratorium that is being sought. And therefore, the expectation is very clear that the moratorium numbers for most private banks will be significantly lower than what we saw post the first quarter.
Let's talk about consumption as well. Earlier when the wave just started about the lockdowns and what's happening, people were worried about change in consumption trends. The news flow that you're getting in and around from companies now, the news flow that is coming, probably on the credit card article today where spending seems to be back to pre-COVID levels. You get a sense that consumption change may not last for long, or the trend may continue to be the way it was before pre-COVID soon?
The only question here is the leverage consumption. So obviously there is a lot of pent-up demand that will come through, which is pent up over the last 3 months or more. That will give us a false sense of return of consumption in the near term. I think what's more important to see is how the leverage consumption comes back. And again, when we are talking consumption here, we need to segregate the rural and the urban economy here. Rural clearly is seeing a significantly faster bounce back. There is the MSP support that the government is giving. There is the Manrega funds that are going in. There is, there is clearly local retail buying that is coming in there. Most estimates and most numbers that we are seeing and our own understanding of what is happening there is that the urban demand is actually, is coming back, but it's coming back in patches, and it's definitely slower than the rural demand pickup.
What will be your top picks? How would you advise your clients to go ahead from here on? Which are the sectors where you would be bullish, and what are the trends that you would watch out there?
So, we just came out, just before the conference, we also put out our strategy report. And while I don't want to talk individual stocks, we do believe that, this is a liquidity-driven rally. Liquidity-driven rallies have abrupt ends, and we are cognizant of that, and which is why we remain defensive in our strategy. We want to, we like the pharma space. We continue to like, some large private banks. we're excited about the chemical space. We're basically saying this has got to be a bottom-up approach. There isn't a one-size-fits-all. At the other side of this liquidity deluge, you don't want to be holding companies that don't have the fundamental backing. And therefore, while it just seems like a big party at this point, you need to do your work. This is a tough time to be a fund manager. The fundamentals are not stacking up, but the liquidity is pushing stock prices up and forcing them to not be on cash. But I would stick with large, high-quality names as a preference, and whatever little alpha you can do a little bit of stock picking and going into mid caps just for that little bit of alpha. But largely, I'd say 80-20 in the large caps only.
Right, but just again the point about large cap versus mid caps, in all crises you've seen large cap emerge much better and much stronger, the ones that survive. You think this time around this will be no different?
Yeah, I mean the mid caps, the underlying principle for the mid caps is always that you need a sustained economic recovery, and otherwise some of the mid caps and the SMEs will actually face an existential crisis. So without a doubt, our view is that the big will get bigger. There will be more consolidation in the industry than there is today. And therefore, which is why we like the large 4 or 5 large private banks. We like the large companies because we're very clear that there will be more consolidation. These are the companies that will get bigger on the other side of the COVID issue. Whether they do this through consolidation and opportunistically going and acquiring smaller companies that are seeing the pain today. But without doubt, the large companies get bigger. You have to be very selective when you go into SME or into mid-caps because a sustained economic recovery or a sustained GDP growth is still some time away. And you could very well see a W-shaped recovery playing through.